Hey everyone, and welcome back to the channel where we demystify the complex world of finance. Today, we're diving deep into a fascinating corner of the market, how to borrow stocks and the mechanics behind a potential short squeeze. We're going to use a real-world example straight from our screeners, focusing on a company called RYOJ Boba Company Limited, trading under the ticker RYOJ. We'll uncover why it's appearing on our radar, what the numbers like its incredible cost to borrow mean, and what you should watch out for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk about RYOJ. RYOJ Boba Company Limited is a Japanese company operating in the industrial/consulting services sector. They provide consulting and health services, splitting their business between labor and corporate consulting and broader health services. With a market cap of just $47 million, RYOJ is a micro-cap stock, which often means higher volatility and unique dynamics. To chart RYOJ's 30-day price action. Looking at recent price action, RYOJ has been quite a mover. Today, it's down 8.33%, and over the last 5 days, it's seen a dip of 3.10%. However, zoom out a bit, and you'll see it's up a substantial 39.86% over the last 30 days. Volume today was remarkably low at just 8,415 shares, a sharp contrast to its 30-day average volume of 438,127 shares. This relative lack of activity today is important context. What is cost to borrow and why it matters? Before we dive into RYOJ specifics, let's quickly explain one of the most critical metrics for short squeeze potential, cost to borrow, or CTB. Pure text cost to borrow CTB equals fee to borrow shares for short selling. When you want to short a stock, you first need to borrow shares from a broker. That loan isn't free. You pay a daily fee and interest rate to hold those borrowed shares. This fee is the cost to borrow, typically expressed as an annualized percentage. Why does it matter? A high CTB indicates that shares are scarce and there's strong demand from short sellers to borrow them. Think of it like renting a car. If every rental car is booked, the price skyrockets. When CTB fees exceed 100% annually, it's a clear signal that the supply of available shares is extremely tight, and short sellers are paying a hefty premium for the privilege of betting against the company. Why this stock is hard to borrow right now? Now, let's bring it back to RYOJ Boba Company Limited. RYOJ. Our screeners flagged RYOJ because its annualized cost to borrow fee is an astonishing 567.1%. Highlight RYOJ CTB 567.1%. Yes, you heard that right, over 560% annually. This is an incredibly high number and tells us that RYOJ shares are exceptionally hard to borrow. With an estimated float of just 2.3 million shares, it suggests that a significant portion of the available shares might already be held by long-term investors or are simply not readily available to be lent out. This scarcity, combined with the demand from short sellers, is what drives the CTB through the roof. Squeeze mechanics explained. So, what does it mean when a stock like RYOJ is hard to borrow with such a sky-high CTB? It sets the stage for a potential short squeeze. Show animation short squeeze mechanics. Here's how it works. Short sellers borrow shares and sell them, hoping to buy them back later at a low price and profit from the difference. But if the stock price starts to rise unexpectedly, these short sellers face mounting losses. Simultaneously, that exorbitant 567.1% cost to borrow on RYOJ shares starts eating into their profits, or accelerating their losses, every single day they remain short. At a certain point, the pain becomes too great, and they are forced to cover their positions. Covering means buying back the shares they initially sold. When many short sellers are forced to buy back shares at the same time, this creates a surge in buying demand. This demand pushes the price even higher, which, in turn, forces more short sellers to cover, creating a positive feedback loop known as a short squeeze. With RYOJ's estimated float of only 2.3 million shares, any significant short covering could have an amplified effect due to the limited supply. However, it's crucial to understand that a high CTB does not guarantee a squeeze. It can also indicate that short sellers have strong conviction in their bearish thesis and are willing to pay a premium to maintain their short positions. Dilution risk check. Another critical factor to consider when evaluating a potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, effectively increasing the total number of shares outstanding. Short text dilution equals new shares equals less squeeze potential. If a company were to issue new shares via a public offering like N-1 or 424B filing, the influx of new supply could easily offset any buying pressure from short covering. Fortunately for RYOJ, our check found no recent dilutive SEC filings such as N-1, N-3, or 424B in the last 90 days. This means that, currently, the risk of the company itself flooding the market with new shares to negate a potential squeeze thesis is low. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you keep an eye on if you're watching RYOJ for short squeeze potential? While the 567.1% CTB is compelling, today's negative 8.33% price action and extremely low volume of just 8,415 shares suggests no squeeze is happening right now. A true short squeeze often starts with a significant increase in buying volume and a sharp upward price movement. We'd want to see RYOJ's volume pick up dramatically, especially on green days, signaling accumulation. We also monitor changes in the shares available to borrow. Shrinking supply could indicate increasing demand to short or existing shorts getting squeezed out. Our internal composite squeeze score for RYOJ currently sits at 42.4 out of 100, which is respectable but not in the imminent squeeze territory, reflecting the various factors at play beyond just the CTB. Keep an eye on RYOJ's price momentum, particularly if it starts to reclaim some of that 30-day gain of 39.86% with heavy volume. RYOJ Bob Company Limited. RYOJ presents a fascinating case study with its exceptionally high 567.1% cost to borrow, driven by an estimated float of just 2.3 million shares. This is a prime example of a stock that is extremely hard to borrow, a key ingredient for potential short squeeze. While the conditions for scarcity are certainly present, remember that the market is complex. Always consider the full picture, including dilution risk, which for RYOJ appears low currently in current price and volume action. We've seen RYOJ's recent strong 30-day performance, but also its recent dips and very low volume today. It's a situation worth watching for educational purposes to see how these dynamics unfold. If you found this deep dive into RYOJ and short squeeze mechanics helpful, please hit the like button, subscribe for more unique stock analysis, and let us know in the comments what other stocks you want us to analyze. Thanks for watching, and we'll see you in the next one.